Hello and welcome to another edition of Buy or Sell. I'm your host, Adam Keily, host of Comedian versus Economist podcast and widely regarded as one of the simplest minds in finance. But luckily for us, I'm joined by an expert to educate me and hopefully you on how they're thinking about stocks and the stocks they're thinking about. This isn't a deep dive though, of course. We're going to get through as many stocks as we can in the time that we've got. And you can find out more information about each of the stocks on the Equity Mates website. But let's get stuck into it. I am very excited to welcome back to the show Roger Montgomery, founder and chief investment officer at Montgomery Investment Management. Welcome back, Roger.
Thanks very much, Adam. Great to be on the program again.
Yeah, great to have you back. Have you been well?
Yes, extremely. And despite the rocky road in markets at the moment with Trump, heading to what appears to be, authoritarianism in the United States, we expected a lot of volatility this year, and we've certainly seen some already.
Yeah, and you're handling the volatility, or you're thriving, or enjoying the volatility.
Yeah, I think so. At the start of the year, we thought that this year would be positive, not as positive as the last two, because statistically, well, historically, we just haven't seen three really good years after two. The first 2 years are more than 20% gainers each time. And so historically, I think it was only once in the last 100 years in the 1980s that there were three consecutive double-digit years. So we weren't expecting this to be different. The other thing is we know that historically the biggest volatility, the largest drawdowns historically have occurred with a Republican president sitting. And that might be a function of the fact that markets get very excited about the looser approach to regulation and tax that Republicans advocate. So that means the market maybe gets a little bit ahead of itself before a Republican president steps into the White House, and then they get disappointed with the reality. So, for those two reasons, we thought this year would be a positive year because we still have, well, relatively speaking, disinflation and positive economic growth, which are good for innovative companies.
Yep.
So we thought it'd be positive, but maybe not as positive as prior years. And certainly, as I mentioned a moment ago with Trump, we expected more volatility.
All right. Hey, last time we asked you what your drink of choice was. We're not in the no holds bar anymore. This time I want to know, what would your investing theme song be, Roger, if you had to have one? We are looking at all buys today. So would it be Buy by InSync maybe, or something like that?
Probably The Gambler by Kenny Rogers. You've got to know when to hold them and know when to fold them.
I love it. Very good. Classic.
I used to know all the lyrics to that song. I used to be able to sing it. Yeah,
you couldn't give us a few bars, could you?
No, I'm definitely not doing that now. Sorry, I'm not going to give
maybe
you that
back
pleasure.
in the no holds bar with a whiskey or two. Maybe we could get something out of you. I did mention we this is your second time on the show in the buy or sell. We had you on back in May, and I just wanted to get your thoughts on. So you gave us some stocks back then. You can find those on the Equity Mates website. A couple of big winners that you gave us back then was Telex Pharmaceuticals up 67%, and we're talking about them today. And CBA is up 54%. Any reflections on those two as the sort of bigger gainers in the last set of tips?
Well, the revenue from Telix's primary prostate cancer diagnostic product is, it's growing at high double digits, 50, greater than 50% annually, and it's quickly gaining share from competitors. So that thesis that we talked about last time, that's just playing out. And there's hope now being built into the price that there's a broader pipeline of oncology opportunities, for example, brain cancer and kidney cancer, that its products can be applied to, and maybe some of that is now creeping into the pricing of the stock.
Right. Okay. And what about CBA? CBA is up 54%. I keep hearing that it's overvalued. Is that the case now?
Well, I think when I spoke to you last, we pointed out it was the largest. CBA was the largest position in the Montgomery Fund and the Montgomery Private Fund.
Yeah.
We were underweight. We're still underweight that position because we simply can't have 25 or 27% in the banks, which they now command in terms of index weighting. So we can't match that. But it was the biggest position. And I think it's benefiting from an unwinding of the US exceptionalism trade, which has propelled US markets for many years. The idea that the US has, the best demographics, the best agricultural land, the best military, the safest currency and so forth, and the best innovation, that some of that might be unwound thanks to Trump, and consequently money's looking for other homes, with the CBA being a relatively stable, a very stable company. If you live on an island, it's great owning a bank. And the fact that it's the biggest company, I think it's the recipient of some of those cross-border flows.
Yeah, okay. Interesting. And just a couple to touch on that were down. So Novo Nordisk is down 43%, Macquarie Technology down 30%.
Yeah.
Any
So,
thoughts on those ones?
the first one went up after we spoke, I believe.
Yep.
It went up first and then came down. So we haven't spoken in the intervening period. But really, I think the optimism around weight loss drugs, that sort of started to run its course.
Yeah.
And so this stock became very, very expensive. And any bad news or any sign that the take up rate of those drugs is slowing, that's enough for people to reprice the stock. So that's what happened there.
All right. Why don't we get stuck straight into? We've got 11 stocks to get through today.
It's a lot.
And we're going to start with Cochlear Limited, ASX COH, currently trading at $269.35. Roger, I hear great things about Cochlear. I hear great things could also be their tagline, I guess.
Yeah, good point.
Where are we at with Cochlear?
60% market share in that implantable hearing device market. They've consistently grown at double digits. Most people of my generation know the business was responsible for rectifying hearing impairment in children.
Yep.
That's now moving to the seniors market. Baby boomers who went to a lot of concerts, listened to a lot of Bob Dylan very loudly, and Kiss. They've got hearing issues now.
Yeah.
And so, some of that growth is now being driven by implants into seniors in developed markets, and they're continuing to grow the market significantly in developing markets for children.
Yeah.
What's surprising is that even after 40 years of operations, they've only penetrated about 5% of that severe hearing impaired market.
Oh, wow.
So there's a lot of growth to come. There's a long runway of growth ahead. There's a new Chinese factory which is producing lower end products for developed markets and for government tenders. So yes, the share price has been flat for a while due to softer services revenue. So that's the revenue they generate from servicing the products that they've implanted.
Yep.
But they've also, launched a new sound processor, or they're about to launch a new sound processor, I should say, and that should help them get back to that double-digit growth rate.
Right. Sounds like a big opportunity there if they're only got 5% of the market at the moment.
Yeah, exactly. There's a lot of growth, and it's got a great reputation.
All right, so Cochlear is a buy. Next up, we're looking at QBE Insurance Limited, ASX QBE, currently trading at $23.38. QBE Insurance, Roger, I don't know if you knew this, founded in 1886.
Yep.
Back then, they only offered contents insurance because homes hadn't been invented yet. So
neither had the car. I think that was 2 years later.
Yeah. QBE Insurance is a buy. Why is that?
Well, look, it trades at a discount to its peers. I think the market's yet to fully recognise the fundamental improvements that are happening, particularly with respect to the earnings quality of the business. Their $30 billion portfolio, their float, if you like, that benefits from high short-term bond yields. And that's going to enhance its profitability. And I think that hasn't been priced in.
Right.
We know they're disciplined underwriters. They're extremely disciplined around acquisitions. Premiums are rising, and they've got reduced exposure to catastrophes, which is a good thing given climate change appears to be evident in a lot of the anecdotal reports we're hearing in terms of storms and water temperature and that sort of thing.
When you say they've got reduced exposure to catastrophes, how is that? How are they not exposed to? We've seen floods this year.
Well, they're just not insuring in those disaster-prone areas.
Right, gotcha.
And so that's reducing their dependency on or rather the risk associated with being exposed to those areas.
Yeah, gotcha. All right. QBE is a buy. Next up, we are looking at Telix Pharmaceuticals, ASX TLX, currently $25.49. We touched on this one during the opener. It's been a strong performer already. Is that set to keep going, Roger?
Well, the thesis is the same as
Yep.
what I just mentioned. The revenue from the Illuccix, the prostate cancer diagnostic, it's growing now greater than 50% annually, which is awesome. And the opportunity to expand into a broader oncology environment, if you like, and I mentioned brain and kidney, for example, that's going to stand it in good stead, we think.
Yeah, excellent. All right, next we are looking at TechnologyOne Limited, ASX TNE, currently $41.15. I was looking at their website. They don't just offer SaaS like everyone else; they offer SaaS Plus. No idea what the Plus actually gives you. Maybe it's their
Just more.
streaming service or something. I'm not sure. But TechnologyOne is a buy for you, Roger.
Yeah, this is a business that's been growing 10 to 15% a year for more than 20 years. And they've now got strong traction in the UK higher education market. And through their acquisitions of Scientia and Courseloop, they're able to cross-sell, and that's helping to boost margins as well as revenues. And SaaS Plus is really about bundling.
Right.
That's software and support, and by combining those things, it expands your addressable market, but it also expands margins and profitability, which is great. We just think this business is going to continue to upgrade over
Yeah.
the next few years.
I used to actually use it at a university I worked at.
Yeah, right.
Must
There
be
you go.
20 years ago now, when it was Student One was their education platform. I don't know if that's still the same case or if it's all been bundled together into that SaaS Plus. I'm not sure.
Yeah, exactly. Well, that's
Mm.
the plan, right? By actually you can extract a higher average revenue per user
Yeah.
by bundling.
Yeah. Excellent. All right. Next, we're looking at Life360 Inc. ASX 360, currently $31.98. It's a popular family tracking and communications app, now offering pet tracking too. So your dog can let you know when he's going to be late home for dinner, Roger, which is good news.
Yeah, a lot of people.
Life360 is a
This is an
buy.
interesting one. A lot of people say, "Well, I've got Find My Phone and
Yep.
my family plan, so I can see everybody's devices." But if you're all with Apple, that's fine. But if you're not,
Mm.
if you've got some Apple and some Android and so on, you're not going to be able to do that. So this is actually the fourth most used social networking app in the US.
That's
Um,
incredible.
there's a high frequency of usage, obviously. There's
Mm.
an emotional element to it because it's safety focused.
Yep.
So what we're seeing is strong user growth, despite privacy concerns. People are willing to say, you know what, I'll risk giving up some of my privacy for the safety of my family.
Yeah. Right.
And they've got data-driven targeted advertising as well, which they generate revenue from. EBITDA is now positive, and the cash flow is expanding. Not only, as you mentioned, pet tracking, but also tracking elderly parents. So we've got, the biggest cohort in the world at the moment, the baby boomers.
Mm.
They're also called the sandwich generation because they're looking after adult children, but they're also looking after aging parents.
Yeah. Yep.
And this product is playing into that space.
Yeah. Right. Very good. They could team up with Cochlear, maybe have a combined offering for seniors with
Yeah, so
better
you can hear
hearing
the
as well as
pings on the
tracking.
alerts on your phone. That's right.
Yeah, yeah. All right, next we're looking at Superloop Limited, ASX SLC, currently trading at $2.85, not to be confused with the Superloop London bus service, which
Yep.
also offers impressive speeds, up to 30 miles an hour, I believe, Roger. Superloop, the internet provider, broadband, NBN, where are we at with Superloop?
Yeah, look, it's for its earnings growth, which is relatively strong, 12 times EBITDA, which is where it's trading, is pretty attractive. Of course, there's risks. There's competition and pricing pressure, but they're now white labeling their product with energy providers. So you might have received an alert from your gas or electricity provider that you'll get a cheaper rate if you take up their internet service.
Mm-hmm.
That's powered by Superloop.
Right.
And
I did get one.
there you
I'm with
go.
Superloop, right? I'll put that
Yep.
out there. Full disclosure, I'm with Superloop for my home NBN, but my electricity provider said, "Hey, would you like us to bundle internet?" But it worked out to be more expensive than staying with Superloop, so I stayed where I was. So,
Yeah, right.
um,
There you go. So they're actually the reason why that's the case is they're the lowest cost NBN provisioning. They have the
yeah,
lowest cost, and that's because of their tech stack,
yep,
which is more modern. And they've got no legacy issues that they have to deal with as a challenger,
mm,
and that means they can either deliver a lowest price product and grab market share, or they can maintain higher margins.
right. This is going back a while. I've been a long-term customer. Someone told me they had their own backbone, and I was like, "That sounds amazing to me. I'm on
There you
board."
go.
I didn't
Excellent.
know what it meant, but it sounded good. It sounded
What we're
robust.
talking about, it's that tech stack.
Yeah.
Yeah.
Yeah. All right, let's take a break here. We're going to be back with more buy or sell right after this.
When it comes to good investing, good research is paramount. And we know that sometimes you don't always have the time to dig through financial statements and find those individual companies.
And even if you love researching stocks, it's always good to get a second opinion, to get differing voices, and to uncover companies you may not have been looking at, which is why we love good research.
Good research is how I found Antipa Minerals, one of the companies that is in my $500 to $5,000 challenge. It's also the research that Luke and Ben use from Seneca Financial Solutions to generate 36.5% per annum returns on their top-rated small caps fund.
So what do you get? You get 2 in-depth reports each month on ASX-listed companies with a real focus on emerging companies and investing opportunities that a lot of investors are overlooking.
Good research is only limited to 200 subscribers, so don't miss out. But the good news is, as an Equity Mates listener, you get 10% off at checkout using the code MATES.
So head to goodresearch.com.au to sign up, but be quick, spots are filling up fast.
Good investing starts with good research. Don't miss out.
Welcome back. You're listening to Buy or Sell. My expert today is Roger Montgomery, founder and chief investment officer at Montgomery Investment Management. And next up, we're looking at Bapcor Limited, ASX BAP, currently trading at $5.24. Bapcor say they are the unseen parts of every Australian journey, Roger. That's usually my sunglasses. I never know where they are on any holiday.
Yeah, they're unseen. My
Unseen.
sunglasses are
Yeah.
unseen as well. Sometimes I lose them on my head.
I'm glad I'm not alone there. They're up 22% the past year, though. They're doing
Yes.
all right by the looks.
Yeah, they are. New management strategy, still trading relatively modest PE of about 16. I think, I think a lot of people overplay, or a lot of investors overplay the impact of EVs on the Australian fleet. Yes, EVs are growing and hybrids are growing. Hybrids still have a motor that needs to be maintained. That's where Bapcor comes in. But really, even though EVs are growing as part of the fleet, the fleet is so large, and we have something like 1 million new cars a year that are sold, that it's going to be a decade or more, maybe 2 decades, before you start to see any kind of real impact on the need to maintain ICE cars, or ICE vehicles, ICE, internal combustion engine vehicles. They'll still dominate the national fleet for a very long time to come. They also benefit from population growth, the aging of the car park, or the fleet rather, and falling interest rates are helping them as well. So, yes, there'll be a challenge from that long-term EV transition, but it's small, and it's probably, the risk is probably overplayed, and that's helping this stock to remain at a relatively good value and a good opportunity for investors.
Yeah, I actually just bought a secondhand car today, and
What did you buy today?
I bought a Toyota Corolla
A Toyota Corolla, so
because they
an
are
internal
they're
combustion engine
bulletproof.
car.
Yep, ICE bulletproof car. We just needed a second car, and
Yeah.
the upfront cost of an EV was going to be way more and the secondhand car market, I didn't trust a secondhand EV, so I thought.
Well, that's one of the reasons why people have slowed down their purchasing of those vehicles. There's many reasons, but one of them is the resale value.
Yep.
And that's a big problem for the technology advancing, and it's a problem for it being more widely accepted.
Yeah. All right. Next, we're going to look at Pinnacle Investment Management Group, ASX PNI, currently trading at $20.76. Some say the pinnacle of investing, Roger, up 50% over the past year. You think it's a buy?
Well, we own it.
Yep.
We're not buying it right now. We already own it. It's already
Sure.
in the portfolios in the small cap team. Really, it's up because the earnings growth has been very good thanks to strong distribution and administration services for funds, the funds that it looks after, particularly private credit. That we're seeing enormous growth in the private credit space, and that's for a number of reasons. One, because we've got that generational avalanche that I alluded to earlier, the baby boomers.
Mm-hmm.
They're retiring. Their appetite for risk as they age falls. And so private credit is offering an attractive return without the public market risk. Pinnacle distributes one of the giants in that space in Australia. And so they're benefiting from that growth in FUM. And that's helped the share price to do well because earnings are growing despite a relatively tough equities market.
All right. So Pinnacle Investment Group is a buy. Next up, we've got Ingenia Communities Group, ASX INA, currently trading at $5.59. Just like a fine wine, Ingenia is getting better with age of its customers. Retirement accommodation and holiday parks. Roger, this is a buy for you as well.
Yeah, importantly, I should say affordable retirement accommodation.
Okay.
It's a big deal when people are downsizing. One way that, the biggest asset for many people is their home. If they can sell their home and downsize into something much more affordable, that leaves them with a nest egg that they can live off and enjoy the later stage of their lives.
Enjoy the water park at the
and the bouncing,
holiday
the
park.
big trampoline, the big bouncing trampoline. That'd be a lot of fun. My knees wouldn't hold up to that, but maybe others can. Anyway, so they're benefiting from that. Obviously, they're leveraged to population growth and the aging of that growing population. So very long runway for growth. They're also benefiting, of course, from lower interest rates, and those thematics aren't going to be disrupted by Trump or anyone else in the short term.
And so people are living longer than ever too. I presume that
Exactly.
plays in well for the Ingenias of the world who just make
it
money for
will,
longer.
provided they can get the turnover. They need to be able to keep selling. So that's true.
Yep. All right. Next up, we've got Imdex Ltd, ASX IMD, currently $2.75. It's drilling and data. It's like Bunnings with computers. What's not to love? Where are we at with Imdex?
Yeah, look, this is a business that has essentially what it's selling are cloud-connected sensors that help resource companies, mining companies optimize their drilling. So you remember that, you'll have a fairly good idea of what they do. Their competitive advantage lies in their proprietary technology, which is delivering better data or more valuable data for extracting resources by those mining companies. Shares are up 25% in the last 12 months. And there's still upside from a recovery in exploration and drilling, particularly in gold and copper. And with the gold price rising as Trump devalues the US dollar because of his behavior, you're going to see more of that in the future. And then if we get a cyclical recovery, very likely as commodity prices continue to improve.
Right. Okay, so that sounds good. Imdex is a buy. And finally on the show today, we're going out with a bang. And if you're going to go out with a bang, you better have insurance. So we've got AUB Group Limited, ASX AUB, currently trading at $35.46. It's a buy for you as well, Roger. Why do you like AUB?
Well, it's got one of the largest, if not the largest, broking network. And it focuses specifically on SMEs, small and medium-sized Australian corporates. It's trading at 18.5 times next year's earnings per share, and it's still producing double-digit, or the expectation is that it's going to produce double-digit earnings growth, which is fantastic. It grows organically and by acquisition, and it's expanded into the United Kingdom. That's going to help it expand its margins because it'll be able to extract synergies out of those acquisitions. We think it's got a defensive growth profile, so it's resilient. It's not sensitive necessarily to the economy. And it benefits from inflation and interest rates going down. Either of those scenarios are good for it. The risk is that there's pressure on premiums over time, or that we get a recession, and that could put businesses under. And of course, if there are fewer businesses, there's fewer businesses insuring themselves.
Right. Surely recessions can't happen with Trump at the helm, Roger. That's off the cards, surely.
But wars can, so we'll wait and see.
Indeed. Better have insurance. Very good. All right, that does it. Thank you so much, Roger Montgomery, for joining me on Buy or Sell. Where can people find you if they'd like to hear more, see more of your work?
Well, we were talking about private credit earlier. If they're interested in the private credit funds that we offer, they can go to montinvest.com. And if they're interested in our thoughts on markets, rogermontgomery.com.
Okay, excellent. You'll find it all there. And you can, of course, continue the journey on the Equity Mates website. There's plenty of resources there. You'll find the buy or sell tracker for this show, along with the Find a Company page, where you can find more information on each of the companies that we've talked about today. And if you're looking for me, you'll find me chatting to my economist brother on Comedian versus Economist, with new episodes every Wednesday. But until the next buy or sell, it's bye for now.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.